Hi guys, good evening and welcome to Money Control Markets Weekly. I'm Karunya Rao and joining me today is Gurmeet Chadha of Complete Circle. Gurmeet, always a pleasure to have you on board. Welcome.
Thanks, Karunya. Likewise. Always good
So,
to connect.
what are you making of the market mood? Because you were just talking about some yo-yoing happening in the markets before we started this conversation, and not only intraday, but that has been the flavor for quite some time now. It has seen its very good days followed by a lot of volatility. So, what should investors make of this, and what should they do in times like this?
So I think markets always tend to take you by surprise, and one thing I've learned over last 17, 18 years in markets is that it's only when the news is bad prices are better. And who would have thought that in about 6, 7 weeks we will be less than 5% away from all-time highs with all the negative news on rate hikes, inflation, geopolitical issues, right? But this is what equity markets are. The equity markets are generous to people who follow a discipline, and they have a stomach for volatility, which I sometimes I think is very, very underrated. I think few things investors need to watch out for. One is the fact that we are not done with the interest rate hikes yet. If you see the FOMC minutes, there will be some more rate hikes. So
Yeah.
your discount rate in the market is going up, which is what we say the relative attractiveness between fixed income and equity, which we say. And especially the new investors in last few years, they've not seen high interest rate environment, right? This is something which will be relatively new. And also the fact that Fed will also do quantitative tightening. People have forgotten that they will withdraw liquidity from market, and they have right now only withdrawn zero point 0.1, zero point 0.2 trillion out of the 9 trillion balance sheet, which the Fed expanded to during COVID period. So that's going to also have. So it's rising interest rates and withdrawal of liquidity, which eventually will. So one quick thing to track here is always track that the yields, if they are moving up very sharply. My experience tends to be whenever the 10-year has around 3.5, it tends to lead to flight of capital from emerging markets. That's the first barrier you should keep about how much is the 10-year rising internationally, which is the US as well as domestic. Keep an eye on the dollar index also. So a sharper movement there also tends to create some volatility. And while we can't price geopolitical risk, just be a little balanced, right? If you can, we've had 2 good years, 2020 and 21. If this is a year which is even little single digit or you are preserving money, I think we are good. So if you temper down a little bit of expectations, I think you should be fine.
I know you're an eternal optimist and you like to see things from the big picture. But if we look at the recent trend of market resurgence, things seem to have taken a very positive turn and very suddenly. Of course, we've seen FIIs making a comeback, Reserve Bank, which until recently was battling exchange rate pressures and expended reserves. So that came in at a much needed breather. We're witnessing decent earnings, if not great, largely on expected lines, no negative shocks or surprises there. Is it too early perhaps to rejoice, or do you think the rally, the resurgence, the strength is justified?
I say that I personally think unless there is a geopolitical situation and we get into a full blown escalation, I think the worst clearly seems to be behind. While we are not out of the woods, but I think probably what we saw in June, I think that is unlikely unless, as I said, there is a black swan event which is not on the table, which could be geopolitical. FIs have pulled out, $35 billion in last 9 months, and almost $50 billion in last 1 year. I've not seen this kind of outflow in my 17, 18 years. And the fact that we withstood it, I think India was relatively far more resilient in the fall also. If you see, we fell about 17% from the peak. And if you look at global markets, look at NASDAQ, for example, it was down almost 40%. S&P was down probably 24, 25%. So outperformance is always both sides. So obviously when things become better, India has done relatively again better in terms of picking up. And mind you, the FIs have only put in 3.5 billions right now, right? They pulled down 35 in last 9 months. So I think, there will be some consolidation. We've had almost 12 straight days of buying exception today. There will be some consolidation, and you should focus on where the risk reward is better. Don't overpay. I think one learning in this year is that, and I keep saying that since interest rates are going up, there's an opportunity cost to everything, right?
Yeah.
So when the discounting rate goes up, you have to be very clear that you have to, and look at what has corrected more. High 100p stocks, cryptos, the risk assets and the growth assets took a lot of beating. Anything which was more reasonable corrected relatively less. So have, as I said, this is a year to manage risk better and be a little more balanced as far as allocation goes.
I want to also talk about the overall demand scenario, because from the standpoint of recovering aggregate demand, consumption and investment both are still a bit depressed. The uplift in private consumer and business spending is weak. Dependence on the government expenditure is still considerably high. So, do you think what we're seeing right now is an unequal demand recovery of sorts? And by when do you think things will stabilize further?
So I agree with you there. I think it is asymmetric. It's not that there is a secular uptick in pockets, and that's why you probably have to focus on the green shoots first. I think one green shoot you can see very clearly is the credit demand. So the corporate credit demand this year is likely to be 13-14%. In fact, I met Mr. Khera, the SBI chairman, in one of the conferences. He said that they'll not be surprised with 15% kind of credit growth this year for SBI and 12% for the system. Now, this is coming back after a lot of time. Also, the asset quality is at its probably best in last 7-8 years. I've seen bank balance sheets. And when interest rate goes up, banks with better CASA see expansion of net interest margin, because you are most of the good banks like ICICI, HDFC, SBI, they have almost 50% CASA, where so the cost of deposit doesn't go up as much. And the loans are 70-75% linked to external benchmarks. So they are priced early. So it leads to NIM expansion. There is good credit growth coming, which will have a positive impact, on your net interest income as well. So I think banks look in a relatively better risk reward play. We are also seeing, this housing revival, despite all the, headwinds of commodity. If you see the house registrations are last 9-year high. Look at the disbursal of the home loans. I was seeing the Asian Paints con call. They said 80% of the demand came from repainting, right? So this trend of having a better house because of work from home, because of so many other factors, other than the new housing demand is there. So building material looks up another interesting play. Similarly, I think in manufacturing, we are seeing some signs of this import substitution and China plus one in select pockets, specialty chemicals, textiles, electronics. Some pockets are seeing. So focus what, as I said, is where you are seeing the green shoots. Ensure that you are not overpaying. And I think you should be good after some time.
Okay. But having said that, if we look at the inflation target, there's been a breach for the first time in 6 years. What does that tell you? I mean, people who've been worried about inflationary scenario, and in fact, you and I, people who are not even investing in the markets, can feel the pressure in their spending, in their costs going up, across different aspects of their life. So how big a worry still is inflation? Yes, commodity prices have cooled off. Yes, rupee is also off those record lows. But how real are the concerns even now? And should people be looking to protect their portfolios right now, even now, against in themes that could be affected by a heavy inflation?
So you're right, Karuna. I think inflation worry is real. I think, and one question we need to answer is, while it has started softening, will it raise its ugly head again? And I think that obviously there are some still supply shocks which are there in the system, and that's why I said anything happening geopolitically can put pressure on those already supply chains which are quite constrained. But if you see the trend, if you see, for example, steel prices from 80,000, yesterday it was some 57 odd thousand. Aluminium, copper are almost at 52-week lows. Some soft commodities, agri commodities have again inched up though, but in general the trend is declining. Crude also is now closer to 90 than we saw. We almost saw $125, $130. So I think that will also start coming off, with a lag. But I agree with you. I think the inflation will take much more longer. The market right now, what pricing is that inflation will fall and the rate hikes will not be very aggressive. Now, whether that is right or wrong, only time will tell. but we need to be watchful. So that's why I said, have a balanced portfolio. So if you're getting a 10-year government bond today at 7.5%, right? And I've seen that whenever 10-year government bond has been between 7.5, 8, the next 3 year returns of even fixed income are pretty lucrative, right? So have a more balanced approach right now. There is no harm in taking some fixed income exposure if you are little conservative. Equities, don't overpay, be a little staggered, and the best hedge for inflation is equities with good earnings, right? So wherever there is earnings, you will tend to do better. And in an inflationary environment, if it is not doesn't turn too ugly, equities tend to do well, in the over a period of time. So be where the earnings are, and be a little balanced. No harm in taking some fixed income or bond exposure if you're getting yields in that 7-8% band.
Right. But given all these host of headwinds, of course, in terms of macros, along with geopolitical tension and all that which transpired, what do you think was the performance of India in this time around? Overall, the earnings picture, the earnings trajectory. Do you think it was largely okay, expected lines, or maybe slightly better in some cases?
I think I was a little positively surprised. I know I was expecting slightly more downward revisions than it was pretty flattish, if you ask me, which actually is a sign that the companies are getting differentiated. And what I also saw was to look at IT, for example. Not every company had problems with deal wins and margins, right? Some of them did navigate well. In fact, some of the companies have given a slightly better guidance. They've revised their guidance in top players. If you see, Infosys has actually upped the guidance, despite all the talks of US recession. Within IT, ERD players, which is engineering, research and design, have actually given better guidance. In fact, there is a report which says that our ERD services share, which is currently $16 billion, can almost become $60 billion. That's like almost a 3.5x over the next 5-6 years. So we've seen some of the names in ERD. Obviously, there's some euphoria without giving any stock recommendations in Tata Elxsi and few other names. So I think there is differentiation happening. Similarly, in banks, we saw some banks, doing much better on names, much better on NI growth and credit growth vis-a-vis some of the others, right? FMCG, we saw Lever actually doing well with better margins and pricing power coming back. So I think now a differentiation will, set in. Companies which are able to, pass on the prices with pricing power without losing market share will tend to do better, in this phase. So that's why I said you have to up your level of research a little bit, get the risk metrics right, and just because something has corrected doesn't make it cheap, right? So something is just down 30% doesn't make it cheap. You have to still be mindful of what value you're paying. And if you do a good job, I personally think India has done much better. Look at our tax collections, which is where the GST. I saw the direct tax collection, but the final numbers are yet to be out, but looks pretty buoyant to me. Overall numbers look, a lot of macro indicators look much better shape vis-a-vis the rest of the group.
So who were the big outliers for you in terms of sectors or themes this time around, and even for future growth trajectory? Where are you placing your bets?
So the first thing which we are very positive about is this entire financialization of savings and inclusion. I think as I was telling you earlier in the show, kind of redemption pressure we have seen from foreign institutional investors, and the fact that we still held on pretty okay, I think it gives me a lot of confidence on this growing equity culture in the country. And there are various ways to play it. You play it through private sector banks. You have depositories like CDSL. You have asset management companies which eventually start doing well. Even some of the listed card players, right? UPI, in my view, I think is as big a thing India has done in fintech as has happened globally. I think it's a big game changer in the fintech space. So I like that space. I also think that India's energy mix and landscape is changing and changing in a very fast way, much faster than lot of us anticipate. So you should play this theme. So India probably will be a more hybrid market, right? With ethanol plays, with solar and other clean energies, and with EV. So we are tracking this space very closely, because energy consumption is only going to go up. It's the form in which we consume is where the debate is. So you probably have to have a basket approach, which I think will do very well. And I think once this crude prices settle, even this windfall tax and tinkering with it should go at some point of time. We like, as I said, the building material theme, entire the home improvement theme, I call it, where you can play through a combination of some paint companies, cables and wires, tile makers, etc. I think this reminds me of 2003-9, where it was a housing-led capex cycle. Early days, I don't want to jinx it, but I think the signs are pretty positive. Um, we like some of the consumption names. I think especially this out-of-home consumption themes, which probably maybe I could be a bias being a foodie, but that's something which I like in this space, including some QSR names. Including what we are witnessing is that your cooking time has reduced, Karunya, especially in urban areas drastically, and everything in the kitchen shelf is getting branded. And India has a huge market of pulses, spices, dry fruits, confectionery, snacks. 80-90% market is unorganized. So you have very strong players like Tata, like some of the other names which are really getting into it. So these are some of the themes I think I like, and I like IT as a contrarian. I think everybody is negative on IT with US recession and all. I think now there is some value on the table there.
Interesting. I want to get into perspective on auto stocks because of late, whoever we've been interacting with, whether on the technical side or the fundamental side, has been very optimistic about the prospects. There has been a good recovery. I mean, auto sector was an outlier despite all the market correction that was taking place. This one held its own place in all of that mayhem. But I want to flag off this particular tweet that you alerted your followers with, saying that don't blindly dip into auto stocks. So what are the parameters perhaps that investors should look at right now? Because there could be a lot of FOMO buying, people who think that okay, or aage jayega from these levels. So how can they avoid all of that problem and mess later on and do their research now before investing?
No, that's a brilliant question. I think what is fashionable is never profitable, is what my learning is in the markets. So specialty chemicals and APIs and CRAMS was fashionable in 2020. Then you had digital was fashionable in 2021. Now auto stocks have seen a recovery. A lot of that could be in the price. So and mind you, just don't go blindly by the order book. That order book is 3 lakh units and all, because the cancellation rates can be 25-30%. So I think just relying on booking number alone can be a little misleading. Just relying on EV launches, which probably will happen in 2024 and in 25, could upset your calculations. So I think, again, as I said, look where the company is getting the product cycle back, right? So for example, let's say M&M. I think they are not only I think are EV ready, even in SUVs, which is what the highest selling segment these days is. They've positioned all 4 offerings in different price bands, starting from, let's say, 12 lakhs right up to 25, 27 lakhs. They are getting the product laddering right. The capital allocation policy is in place. In fact, last 4 quarters, their ROE has been 17-18%. I'm very impressed with what they have been doing of late. The tractor segment, they have gained market share. They're almost now 43% in the tractor segment, which is the big contributor to EBITDA margin, because that's a more high margin business than the passenger vehicles. And the second half of the year, it's been a lackluster year for rural economy. I think the second half of the year, with kharif acreage being better and monsoons picking up, I think should be much better for the rural economy. And still trades at about 15-16 times earnings. So that's one OEM one can look at. Despite the run-up is not. But some of the stocks in even auto have suddenly gone to 40, 35, 40 multiples. Have to be a little careful there. And in auto ancillaries, you should look at somebody which is more content per car. So one company we track is Minda Industries, for example, where you are seeing kit value per car going up, right? So they are working on the premiumization and EV both. So while they're getting EV ready, they're focusing on alloy wheels, airbags, car seats, something which is little EV agnostic also, and which is more premium, right? So you have to see visibility immediate also. Don't just rely on the EV portfolio. I think that will come into picture probably 2-3 years down the line. And you may have discounted it much earlier. So see what is in the price. I see a lot of stocks run up, a lot of it in the price. And that's why, as I said, be careful with what you pay.
What about commodity plays like auto, of course, one of them heavily reliant. There are metal companies, there are FMCG stocks, and given the massive oscillation that's happening in commodities as well, both soft and metals, and even gold for that matter. Should people stay away from that space for now, at least metals? Because we have been hearing, talking, and reading a lot about fair amount of caution that still persists in the metal space.
It's a very tricky space. Kamina. So, well, let's say, for example, Tata Steel was 250 in 2009, remained 250 till 2019 before it went up to 1700. And now, obviously, the stock split has happened, right? So you have to get the entry right. You can't take a fundamental view on commodities. It's very cyclical, and you have to be tactical here. You have to take money and move out. I've not been very good at it, so I usually avoid. So you have to get the cycle right. My sense is with US looking at soft landing, China having troubles, commodity prices. In fact, the earnings reflected April, May, June. The real and that number may not hold in this quarter with prices being down and demand being slightly subdued, right? So be careful in terms of because there, in fact, there's a reverse theory in commodity. When the P is high is when you should enter, and when the P is low, that's when the peak earnings have happened. You should exit, right? Maybe that can be used as some kind of a benchmark. I would in general tend to stay away from it because it's more of a trading call. But if you get a sharp correction in commodities, let's say you get further correction on some of the commodity stocks, which are very, very integrated players, like Hindalco, for example, with Novelis, very integrated aluminum player, one of the lowest cost producers in the world, one of the very large player in copper. Recycle print is going up, or even somebody like a Tata Steel, which is now deleveraging, reducing debt. Have a tactical play there. If you get an entry opportunity, enter, make your money, and just move out. Don't buy and hold will not work as far as commodities are concerned.
Right. Gurmeet, before we let you go, I know you're pressed on time, but this week gone by has been a big one for all the market participants. Rakesh Jhunwala had passed away past weekend, and we have been sharing a lot of his quotations, his learnings. We've been talking about how he built his portfolio. What has been your biggest learning from the big bull, and if any of his stocks or any of his stock picking style that you've really been impressed with and that you really like?
I'm a huge fan of RJ sir. I met him in the Jeffries bar in Marina Hotel there. First time, much long time back. One stock which I did pick up because of him was Titan, and I was very early in it. So pretty lucky in terms of, and his investment thesis was good. One quote which stood out for me was when Mumbai attacks happened and we had to shut markets, and he said that actually we should open the markets and tell the world that India will not stop, because of terror. I think that just tells you the how high he was on India and on life and very fearless, very high conviction, eternal optimist. And that's how there's a saying that pessimist sounds intelligent. It's the optimist who makes money. I think it just holds true for him, right? So he picked up a lot of stocks because of he was invested in, and I agree with some of the things that I think India, if you see, and I was looking at Nifty today, Karuna, last 5, 10, 15, 20 years, it's 14-15%. Right, adjusted for currency also in dollar terms also. Let's say if you want to, a lot of foreigners want to do that, it's 10%. You don't have to do something very smart in India. You just have to have that discipline, keep that faith that things will keep getting better. And I personally think we have a very, very good decade ahead of us, unless we do some self goals.
Okay, any themes that you want to flag off for the next decade that young investors, newbies could track as well going into the market?
So I think the biggest theme is India. Within that, we can break it into few themes. So I think digital India to me is a great theme. I think what India is doing on this front, on payment infrastructure, on financial inclusion, I think something where the benefits will come. I was seeing the IT spending for the world. Indian IT services got 21% of it. So I think we a lot of sectors, including digital, including I was talking about changing energy mix from you. I think India will lead that. And I think manufacturing, after a lot of time, I'm seeing revival. I'm very gung-ho on textiles, electronics, API and CRAM, some of the niche themes. So I think manufacturing, digital, and this entire financial inclusion. I think these are the 2-3 themes which we are very overweight.
All right, great, Gurmeet. Thank you so much for taking time out and chatting with us. I hope our viewers are taking lots with them after this conversation. Always great to chat with you.
Always a pleasure. Always a pleasure. Have a good weekend. Thank you.